All right. Good morning, everyone, and welcome to this live weekly strategy webinar. Today is Monday, December 19th, and I'm Michael Boutros. Pleasure to be with you guys this morning. Full house. Hey, Fevy, Forex Principles, Marchin's in the house. Apollo, throw those questions over, sir. I'll get them. Marchin, great to see you as well. So what a week last week was. We got the FOMC rate decision. 75 basis points as expected, but we did see some big market movements. So we'll go over the Fed implications. I see your first question there, Apollo. What do you see in the FOMC update, economic forecasts? We'll go over that. And then we'll go over our suite of setups for today. So we'll go over DXY, Euro, Dollar CAD, Aussie Dollar, Dollar Yen with a bit of a move there last week. And then we'll move over to gold, SPX, Nasdaq, and the Dow. As always, any questions or trade setups, feel free to throw them on the message board. Marchin's got two here with Euro, Aussie, and what is that? Aussie Kiwi. Okay. All right. Okay. And Generoso, I got you on Dollar CAD. That's on the list. All right. As always, feel free to throw out those questions. Let's jump right in. So before we get started, a quick look at what we got last week from the FOMC. A quick reminder where you can reach these, where you can find these. I saw a question there from Apollo. You can actually get these right from the Fed's website. I'm going to put the link in the chat box, guys. You can save that link. Whenever you get a Fed rate announcement or an interest rate decision, you'll see it come up right here. And it's going to be in the calendar. You just scroll down to the current month. If there's a quarterly economic projections, you'll see the PDF there. If not, you'll just get the press conference reader. So definitely keep that link handy. But what did we get, right, from the Fed? So I tweeted this out just moments after the release, guys, happened last week. Here's the Fed interest rate decision dot plot, right? So here's where we were in September. You saw that all the Fed committee members were under 5% for 2023. The terminal rate was all sub 3%. So the longer running rate or the terminal rate is basically the natural running rate where the Fed sees a natural or stable interest rate, right? So obviously the December one, we were expecting to see the 2023 cluster move higher, but you essentially have now the majority of Fed members calling for above 5%, some calling for even above 5.5. All right, so that means that the Fed sees runway for further hikes to kind of choke down this inflation read. Now, we got inflation late last week, which showed that it was increasing at a slower pace, but we're still at 7% CPI. I don't think anyone's going to say that inflation is no longer an issue. Also, the longer running rate, you saw that some Fed members moved higher there as well, suggesting that we may have a new normal. You hear that say all the time, guys. I hate these comments, but it's true. So interesting moves, lots of interest rate hikes still on the table. If you look at the economic projections, that was even more interesting to me. Okay, so here was the Fed's economic projections. You don't need a side-by-side comparison because they have the previous projection right underneath. So I tweeted this live, guys, as it was happening. As I noted, they lowered their growth prospects, increased the unemployment rate, increased expectations for higher inflation. Okay, not necessarily a good thing. Okay, so what does that mean? It means that the Fed is likely to continue hiking rates, not at the pace that we're at, but it sees that where they're expecting basically this slowdown in 2023. A quick side note, guys, there seems to be widespread consensus, whether it's guys I talk to on various desks in the city, or whether it's the financial news publications that we're reading. There seems to be a consensus, right? Everyone's kind of on the same page. That's going to be a slowdown, a recession, early part of 2023, and then late 2023, we start to pick up again. That starts to concern me. As a trader, as an operator in the market, that concerns me when the consensus starts to become widespread like that. So two things can happen. It could be worse than expected, and the recession could be much deeper. Or we might actually play out as the markets are playing, but are expecting. But the point being, be careful when you get all of these expectations sort of lining up. I don't want to be with the mass. Here's what the Fed funds futures looks like. This is CME Fed fund futures tool, basically suggests what the market is expecting from Fed interest rate decisions moving forward. February, the next rate decision, markets are pricing in a 25 basis point hike, 68% that we're going to get another 25 next month, or excuse me, in February, right? If you go down out to December of next year, you start to see that the consensus is calling for 425 to 4.5. So what does that suggest? It suggests that the markets are already sort of pricing in the fact that we're going to get higher rates moving to the start of the year, but by the end of next year, the Fed's going to have to cut again, right? That's good for markets, bad for the economy, as it were, right? It would suggest that there would be something on the horizon that they'd have to be easing. So again, that's way far out, but this picture paints a Fed that is not done yet, a Fed that is aggressive and that they have to, really aggressively bring down inflation. The concern is that what it's going to do to the labor markets. You've heard the Fed say that they want labor markets to cool. We've seen that they've started to cool, 200-some thousand at the last NFPs. So what that means for the economy, I'll leave that there for you to decide. But at the end of the day, where does price take us? Well, let's jump right in. Here's the DXY. Didn't give you guys an update. This is still from December 9th because in all honesty, there is no update needed. Here was the weekly chart as it stood. Again, this is back on December 9th. We were sitting right there at the 105 handle. We were looking for some sort of inflection, right? 2 weeks later, we're still straddling that very 105 level. Last week's drop did go for a test of the 52-week moving average. That's now 103.88. Key resistance is still 105 on the weekly chart. So as you can see, even if we bring this into a closed basis, we broke support, still holding resistance. What was our base case scenario last week? Do you guys remember? We were talking about the dollar seeing some strength. It's been a pretty steep decline. We've broken uptrend support, but again, it had us coming in some interesting areas. Here's DXY in the weekly chart. Guys, no change to any of those levels. Here's what the daily chart looked like last week as we were sitting on the downslope. Okay, they're 103.80 is 2017 high, looking for a rebound off of downtrend support. And that was the base case scenario as we were talking in the webinar last week. Even closer, here's what the near-term chart looked like. Here's a 4-hour as we were bobbling along those lower parallels. The monthly and the weekly opening ranges from last week never broke. That's good for us because that basically gives us clear guidance on what we should be looking for into the start of this week. Here's what the daily chart looks like now. Okay, last week did see it drive into that 103.80 level, but then nice rebound right off of it. And now we're actually trading already some 1.3% off the lows. So our base case scenario was to look for downside exhaustion in the dollar. We got it. We got an initial bounce, but we haven't even cleared the monthly opening range. Again, I want to bring your attention here to 105.70 into 105.90. Okay, that's the 200-day moving average. It's a basic 236 retracement of the entire decline from last month's high. More importantly, it's the objective December open, not Mike Boutros' opinion, fact, and it's the monthly opening range highs. So all things held constant, 105.70 to 105.90 is basically like critical resistance for the dollar. A topside breach there would be an objective upside bias, right? Moving into the close of the month. That being said, still looking for 104 support. Mike, what actually are you looking for when you say the word inflection? Febby, great question. I assume people know what that means, but when I'm looking for inflection, guys, it means that it's a low tolerance level in price. It means that the market should, if it breaks, see an accelerated breakthrough, or if it rejects, should see a strong rebound. It means, Febby, I'm not expecting price to sit there long. If it's going to break, I expect to see a run through, not just kind of meander higher. If it's going to see a hold, I'd expect to see a stronger rejection, right? That's what you mean by inflection points. And again, guys, never take my word for anything. Look at price, right? This right here, at where we are right now, 103.82 is a strong inflection range. Don't take my word for it. You can see here, rejection, resistance, resistance, resistance. When it broke, acceleration. When it broke to the downside, acceleration. When it tested it as resistance again, quick snap away. When it broke as resistance, acceleration. When you tested it as support, strong rebound, right? Here we are again. Yeah, we got through, but strong rejection. So an inflection range is basically an area to look for some sort of move in price. If the break happens, you expect acceleration. If the rejection happens, Febby, you want to see that strong snapback. Does that make sense? It's what I call an area of low tolerance, like the price doesn't want to sit there long, right? Febby says, okay, cool, right on, good question. So 105.70, 105.90 being key sort of resistance here on the DXY. Here's what it looks like on the 4-hour chart. And again, no change to any of the levels that we talked about. Again, this is 2 weeks out at this point, still holding support at 103.82, December open resistance at 105.69. Again, that 200-day moving average just higher at 105.90. Where do I get the camera button for the screenshot? Hey, Apollo, can someone tell me? I haven't actually been on the viewer side for some time, but there should be a camera button somewhere at the top of your GoToWebinar screen to take a snapshot. So here's a full screen of the near-term chart for DXY. Now, the major market risk or the event risk for the week, right in the center. Hey, Ted, thanks for that. Ted's saying it's right in the center, guys. So I'm assuming sort of right up top in the center, you should see somewhere a camera button. By the way, everything else, guys, if you don't get a snapshot of something you see here, it's all available on MB Forex. So my Twitter handle is now where you can find all the latest charts and setups. As I said in earlier webinars, guys, I'll have an announcement for you shortly, hopefully here, of where all the new analysis will be available. Put your cursor on the edge of the screen and it will drop down, says Ted. So quick reminder there for any of you who's trying to take snapshots there. All right, that's the last, that's the DXY levels for the week. The biggest event risk for the US is going to be into the end of the week, guys. On Friday, we get core PCE, the personal consumption expenditure. That is the Fed's preferred inflationary gauge. So a lot more weight is put on that, the PCE read, more so than the CPI. So that's going to be on Friday, guys. We're heading into low liquidity environment. You're going to see things start to thin out as we get towards the end of the week and obviously the Christmas holiday. So the fact that we have that event risk on Friday, expect volatility. Listen, if you're going to be in the markets at all, stay super nimble. This is not from an environment, from a price condition standpoint, this is not our ideal scenario for near-term trading as we get into thin holiday trade. When's the next webinar, Ted? The next webinar will be on January 9th. As you guys know, the holidays, both Christmas and New Year's, fall on Sunday. So the Monday will be sort of the observed holiday for most businesses. So we'll be back here, guys, on January 9th to kick off a new year. Hopefully some price action under our belt for the first couple of days of the year, of the month. And look forward to seeing you guys all there. So keep that on your calendar for Monday, January 9th. Okay. So with regards to core PCE, one last comment here with the dollar. Core PCE is expected to come in at 4.7%. That's down from 5%, which is what we got the previous month. This is the read for November. So keep an eye on that as we head into the close of the week. Next up, Euro. So no surprise, as we were talking about Euro at support last week, we also noted or DXY at support, we also noted Euro at resistance. Here's what we published back on the 15th. The levels that we talked about, 2 levels. It's interesting that they both played out, okay? 106.10 and 107.46. We never actually got a test of this. The high registered at 107.36. This is the 618 of this year's objective range, and it's also slope resistance. So again, if we just take a basic parallel of slope support off the yearly lows, extend it to that high that we made back in September, perfect touch there. And again, just 10 pips off before we pulled back. So intra week, we ran right into that region and rejected on a close basis, we couldn't breach that 106.10, 106.37 level we talked about. Okay, that's still resistance. Here was our last update on euro, and again, we highlighted that 110.30, that 106.10.37 level was really critical, and we wanted to focus on what the close was going to do around that level. Obviously, we closed right below. Guys, we've now had 4 consecutive weekly rallies in euro. We're testing uptrend resistance. The threat is for the exhaustion. It's the same exact trade we talked about last week, right? So how did this play out? Well, the weekly chart was pretty clear as far as the levels we were looking at. The daily chart had us coming right into that 107.46 level. Remember, again, 107.36 was the high before posting what? And we noted it here. An outside reversal day. An outside reversal day off of resistance, oftentimes a hallmark of the exhaustion trade. So here's the daily chart as it looks now. Here's what the daily chart, again, looked like last week. That ended up being the outside reversal day on the close, kept the focus lower while below 106.37. Again, that key resistance region that we were looking at. We did pop through, next day failed, reversed right back below. And again, you can see, guys, the slopes, all of these slopes are derived off of the original slope off the yearly lows. So we just ran into resistance and pulled off. Not really very strong or any divergence in momentum, so you didn't really get that tell. But certainly price action was pretty telling. So at the end of the day, the threat is for a little bit deeper of a pullback here in euro, right? A little bit bigger of a rebound there in DXY. Remember, 60% of DXY is euro dollar, so you'll see these move in inverse relationship all the time. Here's what euro looks like on the intraday chart. There's the 4-hour, and here's what the 4-hour, again, looked like last week. All right, no change to any of those levels. We spiked right in and failed right ahead of that 618. On the close of that session, automatically you start to look lower, right? The first level of support comes in at last week's low, which converges on the uptrend, and now comes in at 105.05. Look for a region there. Bullish invalidation, the focus that would shift the medium-term bias lower in euro would be 104.04. Right now, I'm just looking for a pullback into uptrend support. As far as the breakout zone, I see your question here. It's going to be 107.46. If we close above this, you're looking for the resumptive move. At that point, the 50% of the yearly rally takes you to 109.42. All right. Questions on euro? You don't really have any major data out of Europe coming out this week, so keep the dollar price action in focus, keep broader market sentiment in focus. Okay. Apollo with a question here. When is the market expected to close this year and in new year? When is the smart money expected to get back into the market? Apollo, give me some background information on that question. I'm not sure what you mean. Look, well, let me just take a pause there. We'll look at the SPX in a moment. I'll kind of give you what my outlook looks like from there. All right, that's euro. Let's pick up the pace here a little bit. We got dollar CAD on tap. We got core inflation on Wednesday from Canada. So let's start off with the weekly chart as always. Look, the Canadian dollar has sort of been, it's been frustrating for me. Here's what it looks like on our last update. Frustrating just because we haven't been getting the momentum kicks that we wanted. So I published this back on the 16th. Remember, I try to keep them in, sort of keep them in order here so you can go back and see how we've been doing on it. But here was the update back from December 9th. Here's the weekly chart. We highlighted 136.90 as resistance. 3 weeks later, that's still resistance, right? So as you guys know, well, let me just jump into the nearer term chart. So here's was our last update last week. And here's the weekly chart looked like as it was testing resistance yet again. And the focus that I was telling you guys is resistance at 136.90 is continuing to hold. That's the breakout level. that you would need to see the next. So your question earlier about what inflection means, Febby, this is a clear inflection range, right? So if we close a daily close or a weekly close, more importantly, above this, you'd expect to see an accelerated rally, right? You expect to see this thing pop higher. So going back to the daily chart, it was setting up, again, the monthly opening range never really helped to it because it was massive. Here's your monthly open, 3-day stretch, ripped, right? So you have a range of like 2% already for the month right into the open. But the monthly range highs have continued to hold. And that, again, is 36.90. No change to any of the levels. Near-term support is the 2019 May high day close. That's still 135.15. That's with the upslope. So you're still focusing, guys, on a breakout of this range, right? 2 weeks later, it's still the same game. Here's what it looks like on the near-term charts, or here's what it looked like last week. We're still in that ascending near-term trend. No change to any of the levels. This thing has just been ping pong. Okay. So again, if we take into account the dollar performance, the dollar expectation that we talked about, if the dollar is going to show a bit of a relief here, you look for the topside breach above 36.90 to get you the accelerated run. Such a scenario, you're looking for the high day close, 37.50, and then you're looking for the next major resistance zone that takes you up into 38.55 into 38.80. Any questions on dollar CAD? Like I said, you have heading into Wednesday, core inflation rate year on year, we got 5.8% last year, so we'll see what that looks like. Headline inflation is expected to come in at 6.7, slightly softer again from the 6.9 we got last month. Questions on dollar CAD? All right, that's number 3. Ted, I got you on all of those except the 10-year. So let me take a quick segue here. We looked at dollar index and what that's doing, right? Coming off support, expecting some sort of rebound. Here's what the 10-year is doing. Guys, I haven't touched this chart since last week. Ted, I think you were asking about it here in the webinar. Amen says, sorry for being late. As always, great to see you in the room. Good morning. But with regards to the 10-year, Ted, man, the monthly opening range is set right above support. This is your objective monthly open, 360. Here's the side-by-side comparison. Let me show you the daily chart first. Well, you know what? Let's just take the full suite. Here's the weekly chart, right? Mid-range, nothing really to write home about. 354 was the 1618. We've been straddling that for what? This is the 4th consecutive week. Daily chart, I showed you guys this last week, right? Still in that pitchfork off the highs, still off the 25% parallel. Here's the 50 of the rally off the August lows, still support. Monthly open, unchanged, 3607, that converges on the median line. So if we drive deeper and look at this on the 4-hour chart, here's your monthly open, here's your monthly opening range, here's last week's range, right? So it all is, for me, it's all about a break of 360 into 340. I'm looking for a break out of this for the next move. Pistol to my head, you would think that eventually the downside would break here. But first, before it does, we might get a decent recovery if we break the median line, maybe 376 before we start to move off again. But the focus range remains unchanged. Okay, VIX, 10-year, and DXY all ending diagonals. Yeah, you could look at it at some sort of wedge or diagonal pattern. Absolutely, I could see that happening as well. Which would suggest the recovery, right? The exhaustion trade before resumption of the broader uptrend. So hope that helps, Ted, on the 10-year. And again, there's the daily for you. All right. Okay, that's number 4, 10-year. Number 5, let's take a quick look at, believe it or not, the abomination. Or actually, let me hit dollar yen first, and then we'll come back to Aussie. So here's dollar yen. Last update was on the 15th. Again, it's the close of last week. Here's what the weekly chart looked like, guys. This thing has been surprisingly clean. For those of you who don't know me or haven't been in the room for a while, we call this the abomination because of an experience I had early in my career where I was the guy fighting dollar yen like the whole way down from like 145 into the 70 region. So stays irrational way longer than we can stay liquid, and it's one of those trades where when it gets into a trend, it sort of marries the trend, right, and sticks in that directional trade for some time. You get the jackknife, a lot of real just back and forth price action. What we highlighted last week in the webinar was what? That we had come off of broader uptrend support, okay? We highlighted resistance at 138.60, 138.40. We're looking for a breakout of this zone, okay? Ultimately, I do think this does see a deeper move lower, but again, we're coming into trend support. So I can't continue to favor, shorts from here. So as far as the levels are concerned on the weekly chart, no change. Okay, these are all exactly the same. Going into the daily, we highlighted a key resistance range that stretched all the way into 38.85. Okay, here's what the daily chart looks like now. Okay, no change to any of those levels either. The pivot range or the inflection range, Febi, with regards to your question earlier, is this 37.75 into 38.12. This is the region that we've been talking about for some time, right? Even on the way down. This is the 618 of the rally off the lows from August. It's a 1618 from the decline off the high, and the trois, right? There's the 1618. So we've been looking at this region for a while. Again, don't take my word for it. The topside breach saw acceleration. Really strong inflection on test of support. The breakdown, again, saw inflection on the way down. Both tests as resistance saw whipbacks. We're sitting above the 52-week moving average. The focus for dollar yen is on a breakout of this range. Now, 138.85 is 100 off the low. So two equal legs, واحد اثنين ثلاثة, gives you 38.85 as resistance. If this rebound is corrective, meaning the broader trend is lower, rally should be capped by 38.85. If we're seeing a larger rebound in the dollar yen, then a breach above 38.85, an inflection zone, would expect to see a quick breakout towards 140. Also note that a breach above 38.85 would necessitate what? It would necessitate a break or a breach out of a 3-month downtrend. So all the things are lining up. You know where the invalidation levels are. 38.85 is my line in the sand. As it stands, all dollar yen has done is test downtrend resistance and moved back off into that 52-week moving average. So really clear range of what we should be looking for as far as support here on the daily chart or resistance for a breakout. Okay, no change to any levels on the daily chart. Last but not least, here was our 2-hour chart. Looks like we were making a breakout of this descending channel formation, but again, there's 38.85. That's the breakout level we'd want to see to really validate a shift. Didn't get it. We rallied right into that zone last week, right into the monthly open, failed and turned around. Okay, still the focus is on a breakout of this zone. Could be a bearish flag formation, which means, again, if we break the downside of this, you're looking for resumption. 33.90 would just be the first level. That's basically the low close or the low 4-hour close from the month. But you're basically looking for a 131.30 clip if you get a break below here. All things held constant, you're heading right into resistance. So again, if some of these biases today, guys, feel a little precarious, that's because of the environment we're in. That's because of the time we're in. And again, the market conditions that we're in warrants some more caution. All right. Questions on dollar yen? Inflation data out of Japan on the 22nd. So keep that in focus. At the same day, you get the GDP rates out of the UK. So some data there on the 22nd. Okay. Now, number 6. Now let's hit Aussie dollar. So here was our last update on Aussie. I published this again on the 15th of last week. So The weekly chart was showing a very interesting, and again, a precarious move here for Aussie. So you guys know we've been talking about Aussie for a while. My focus last week when we were talking about this was, look, we've had 4 weekly rallies in a row. We're at confluence resistance. And you guys know that level we talked about was 68.70. What's 68.70? Again, objective note, 38.2 from the decline off last year's high. Downtrend resistance for the current operable pitchfork we've been in, again off last year's high. 1, 2, 3. There's the 75% line has been resistance in May, resistance in August, and again last week, really nice reversal off that level. Now, we didn't quite get an outside weekly reversal. I was hoping that we would get something like that, but we didn't get it. So look, at the end of the day, we came off resistance, but support held. And you guys know this level very well. 66.60, 66.70 is a level we've been looking at literally for years. It's the 2019 swing low and the 2008 low week close. Where the low registered, the close of that week was right here. So a big level we've been watching for, like I said, years at this point. You got inflection on the way down, strong pivot on the break, again on the breach higher, pivot higher. That's still key support, 66.60, 66.70, resistance 68.71. Okay, pistol to my head, I would think you'd get another, decent pullback, maybe a drop and a test of the median line before another move here. But at the end of the day, we are at support. So what does it look like on the daily chart? Here's Aussie on the daily, and here's what it looked like last week, right? Really strong rejection. 68.70, 68.42 was the confluence zone we had highlighted here on the daily chart. Again, a 38.2 retracement from the decline off the highs of last year. Also, 68.40 was a 1618 off the low. So again, 1, 2, 3, 1618 was right into that 68.40. That's the opening range highs for the month. We failed there last week. Aussie has made an opening range, a false breakout of the monthly opening range highs, which would suggest the threat is for a break below 66.60, 66.70. So while I have that level as sort of my line in the sand, it's the monthly range lows. Like I said, the 2019 low, the 2008 low week close, all that good stuff. A 38.2 of the rally off the lows is 66.16, 66.19. For me, that's the broader bullish invalidation level. Okay. Initial resistance 67.87. That's the objective monthly open. Here's what it looks like on the near-term charts. And here's what it looked like, again, side-by-side comparison last week. No change to any of the levels. We're simply just testing the median line as support here. Again, resistance unchanged, right? 67.85, basically right there, right just ahead of the 75% parallel. And again, a more key level, if broken, would be 66.16 there at that 38.2. So no change for any of those levels highlighted last week. The threat for a larger pullback off of uptrend resistance. And again, that jives well with the DXY, sort of making a little bit of a bounce off support, right? So that is Aussie dollar. You are clear of Aussie data this week. Again, keep your eye on broader market sentiment and dollar price action. Okay, so that's everything I have on the FX front. I'll come back and get some of your questions, March, in there on some of the crosses once we get through commodities and equities. But let's take a quick look at gold. So I've been getting a lot of questions on gold, guys. You guys know where I was on this last week. As I've been saying, personally, I'm looking for topside exhaustion. I am bullish on gold. As I said to you last week, I do think that the yearly low is in. I mean, that's not really a big call with 2 weeks left, but we came off of really big support. We made a strong outside weekly reversal off support, and we've rallied into resistance. And for the last 3 weeks, this would be the 4th week, we've been holding the August highs, which is 1807. not only the August highs, but also, as I've been talking to you guys, the 52-week moving average, which is 1804. So 1804, 1807, we've been looking at that resistance zone for the last 3 weeks, and more or less for the last 3 weeks, it's held, right? Not only that, but the original slope for all of the levels you see here, all of these parallels, all off the original slope, right there is resistance as well. Okay, so again, Eman, I know that you're a big gold trader, but you guys, it's the same, outlook as I've been telling you since last week. No change. But the threat is still, in my humble opinion, for a bit of a topside exhaustion trade here. Here's the same region. Again, this was published back on the 16th, basically on Friday. I gave you guys this update as we were pulling off, still holding resistance. You need a weekly close above 1808, 1807 to validate breakout and open up the next extended rally here in gold. Till you do, gold is at resistance. It's the same. I feel like a broken record sometimes on some of these assets because it's the same outlook, right? Here's gold on the daily chart. We noted this in the webinar before we turned lower. We said on Monday, we're heading into uptrend resistance. We're heading into the August highs. So we would need to see a clearing of that slope on a closed basis to validate resumption of the uptrend. Well, didn't get it, right? Here's gold on the daily chart. Decent pullback, decent pivot, or decent rebound. I still think the threat is still for the move lower. At the end of the day, gold has set up a beautiful monthly opening range right below slope resistance. Here's your monthly open. It's also the monthly range lows. That's 1768. Resistance at that parallel. Look for a breakout of this zone for the next decisive move here in gold. Pistol to my head, again, my humble opinion of what the technicals are suggesting is that move would be for a pullback lower, 1745, max, as I've told you for the last couple of weeks, max 1730 is where I'd be looking for a possibility for an exhaustion low or some sort of washout. Look at this on the near-term charts, what the 4-hour looked like last week. We were looking at this possible wedge formation, possible triangle formation, sort of consolidating. That's still the focus. Here's what it looks like now. Okay, so no change to any of those levels. 1768 is still the level. That's the monthly open. Break below that, you start to look for, again, that larger downside washout. 1745, 1730, both come in on the lower parallel over the next few days. All right. Certainly something to keep an eye on as you get into Friday on those inflation figures out of the US. Again, real thin market conditions right ahead of a market holiday. You might see some real price action here, but stay nimble on gold. Eman says it keeps testing that resistance, but no follow through, as you always say, Michael. Exactly. So we need that follow through, Eman. And again, based on where we are in time, based on where we are on broader trend, based on where we are with just the broader market environment of what we're seeing, that rally in the dollar could be more of a tailwind, of a headwind here rather for gold and give us that kickback. Now, eventually, as I've said here before, I just want to make the statement clear. I do think this catches a bit, as I do with oil. We'll go over those levels as well. I think oil catches a bit too, but maybe not right away. Right? If we get the larger market turn down that we're expecting, if you see a larger sell-off in stocks, if you see the dollar really catch, or if you see the larger sell, we could get that risk-off flow. And you're seeing that risk-off flow start to materialize. Just over the last couple of days, guys, you've seen that bond prices have moved up as stock market has moved down. That is when you start to see risk-off flows. Be wary, guys. There's people who use risk on, risk off as like a loose term. Even Daily Effects guys did it, where as soon as the market sells off, it's risk off. That's just not the case, though, right? Make sure you take these comments in stride, right? When we see true risk off, you want to see bonds rallying, meaning rates moving lower, right? You want to see stocks moving lower. You want to see the dollar moving higher. You want to see gold moving higher. Those are the risk off, as it were, trades. That hasn't been sort of the main play yet. So be careful. That's all I'll say on that front. But but gold at resistance. I'm going to DM you on Twitter. Yeah, feel free, guys. If you need to get in contact with me for something specific, Twitter's the best place right now, guys. I don't have an email set up yet for the new business, but we'll get you guys that information as soon as everything's set up. And again, I expect to have a major announcement for you guys over the next couple of weeks, maybe into early next year, on where all the analysis will be. All right, so that is gold. I see a question, was that you, Ted, on silver? I haven't updated the silver chart in some time, but here's a quick look. Basically for silver, the thing with me that I'm sort of perplexed at is that silver is sitting, believe it or not, at the yearly open. So despite all the volatility you saw this year, silver's set to close unchanged for 2022, which is pretty radical considering the range that we put in has been what? 35% range. We're going to close the year unchanged. So look, I did have a breakout a few weeks ago of 22.35. I think we talked about that briefly, but on the daily chart, here's silver on the intraday chart. Again, we came off of uptrend resistance. So you expect a scenario if we break that basic slope off the November lows, you'd start to see a bigger sort of corrective move. Again, I think eventually you look to buy that. But there's a couple of things at play with most commodities, guys. You have the argument that slower growth, global growth, basically a recession in the months ahead is going to be reduced demand for oil, reduced demand for precious commodities, meaning lower, right? Obviously, silver is used greatly in production, right? So you have that argument. Then you have the argument that there's scarcity of resources. And with everything that's been going on geopolitically, once China comes back online and once we get through the recession or get past that slowdown, there's going to be scarcity of resources and there's going to be a demand issue, both on some of these precious commodities and again on energy. So that will put a floor under the drop. That's sort of where I am. I think some of this weakness that you've seen in oil, some of the weakness that you've seen that you may see in some of these precious commodities and metals, yeah, that may be because of the recession fears coming ahead. But I think the pullback would be an opportunity because I do think that a demand issue that's in focus right now will shift more to a supply issue as we get into 2023. So pistol to my head, I would think, you have a little bit of a pullback here in play for silver. I'm constructive above 2166. Okay, this pivot zone right here. So yeah, I mean, if we get a move lower, if we get some sort of corrective pullback, I'd be looking to eventually buy that. But at this moment, I think it's sort of like silver in that you risk a little bit more of a washout. Ted, does that help? Monthly open comes in at 2216. That's also essentially the monthly opening range lows. He says yes. All right, right on. Okay, so that is commodities, gold, silver, and let me just hit real quick, might as well, crude before we get into stocks. Apollo saying, Mike, I keep losing my audio. Is it only me? Guys, gotta get a quick sound check. Is anyone else losing audio? Generosa says good. Febby says good. It's fine, says March. And Apollo, it's probably on your end. Sometimes if you log out of the webinar and log back in, you'll get a better connection. Iman says perfect. So it looks like it's just an issue on your end. Lindsay, thank you for that. All right, so let's hit crude real quick because I think this is important. I went over this with you guys last week as where I stand on this. You guys know where I stand on this. I'm constructive. I'm looking for a low. I've been looking for a low. Last week we said we're testing slope support. If our interpretation is correct, this is where we should start to see at least a relief rally, right? And we got it. Last week we rebounded, guys, right off the lower parallel. Okay, this is the weekly chart. No change. No change. Near-term resistance is still 76.87. No change, right? So we've rebounded off of downtrend support, right? Here's oil on the daily chart. Okay. Again, there's that slope. There's a parallel from a swing low back in February. We tested it again back in September on a closed basis. That was exactly where this thing rebounded off of. So former support, now resistance. 77.26, right? 76.87, basically this whole zone right here is critical resistance. Here's what it looks like on the intraday chart. All right, kind of clean this up. I was telling you guys I wasn't really a fan of the near-term chart last week, but here it is. Right? Guess what? 77.26, 76.87 now converges on basic slope resistance from the November highs. So if we breach here, at that point, I would expect to see the larger recovery. Maybe a larger low, a more significant low is in place at that point. Again, monthly open resistance would be the first level you'd be looking for is 80.47. So right there. So that'd be your first sort of level of interest. And a breach above that would, in my mind, shift the focus higher. At that point, we'd be looking for possible upslope for the rally, maybe something like this. Again, this is way too early, guys. I'm just trying to walk you through the thought process we would go through. If we have a pitchfork, if this is the low, right? Look where the 25% parallel converges, same zone yet again. So any way you slice it, for me, at least, my humble opinion, 77.26, 76.87, I'm looking for inflection there. If we get a topside breach, a close above that level, yeah, I would be looking for a larger rally in oil, okay? Again, conflicting fundamental arguments can be made on both sides. You got China shutdown, expectations for recession, slower global growth into 2023 open, all should be negative for oil. True. But like I said, I think the shift will focus to a supply issue. So if China comes back online, if the recession tends out to be not as deep as expected, or we start to get a supply crunch in general, right? I think this thing will find more likely to find some support here and try to move up. Questions? Right. So listen, if we fail here, I could be absolutely wrong. If we fail here and this region holds a break of the lows or a break of this slope, guys, you're looking for a washout into like 66 and change. It's another $10 from where we are right now. So keep that in mind there on oil. Any questions there? All right. Important levels. And every time this thing rallies, everyone starts scratching their head. I hope you guys aren't, right? We've been talking about this for a while. So be careful with the headlines and all the financial news publications. Stay objective to what we're looking at in price. All right, S&P 500. Oh man, what a beautiful trade. What a beautiful trade. Let's start off first with the weekly charts. We've been on this like a hawk, okay? I've been keeping this in series, just really replying to my last tweet to kind of walk you through how we've been managing, how we've been performing with the SPX. Guys, here was our first weekly chart. Again, this is since leaving Daily Effects, was November 23rd, right? The weekly chart, we were saying, hey, watch 4105. It's the February lows, it's former slope support, it's current channel resistance. A few weeks later, again, we noted that the 52-week moving average was coming into that region as well. Here was December 1st, right into the open of the month. There was the test of 4105, the 52-week moving average just a bit higher. Again, weeks we held there. Last week, we went for a test finally of the 52-week moving average before really accelerating lower. As we said, 3906 was the break we needed to really focus or shift the focus to the downside. And boy, did we get that. Again, this was back on December 7th. We had just gotten the reversal off resistance, right? First test, support at 3906 held. Then last week, we went for another test, touched the 52-week moving average, then reversed lower. Here's our last update that we gave last week, right? As I said in this tweet, Watch the weekly close with respect to 3906. Here's the live chart. We closed well below 3906. Okay. It's beautiful. It's a beautiful trade. Okay. So at this point, where are we? Well, I don't think I gave you a scalp update. Yeah, so let me give you the update now on what the daily chart looks like. Here's the daily. All right. So last week, one last test of the monthly opening range highs. Right, here's your monthly open of key resistance. Failed. We closed that session where, guys? Right below the 200-day moving average. This is why we always say it's very important to be mindful of the daily and weekly closes. Intraday, there could be an opportunity, right? But to make an assessment on whether trend is held, on whether we're getting rejection or whether we're getting the breakthrough, is the daily close. And on this day, when we went for a test and a breach of the monthly highs, the fact that we closed that day back below the 200-day moving average is very telling. Okay, shifted our focus back to 39. There's Friday's trade, pushed even lower. Okay, so where does that leave us right now, Mike? Well, I'll show you the near-term chart in a moment. I do have us at near-term trend support, which is coming up, but from a lateral standpoint, the next major key level is 3740, a 618 of the rally off the yearly lows. But before that, here's what it looks like on the intraday chart. Thank you for carrying on, Ted. My pleasure, sir. I appreciate that. Where are you looking for reflection on the counter trend rally? I'm short SPX at 49.05. So great entry, my man. Well done. So two levels I'm looking at now. The May low comes in at 38.10. Decent pivot in price. Again, there was the May low. You can see some decent pivots throughout July. It was the October swing high, okay, before the breakout of the monthly opening range. So that's the opening range high for October. And that converges on the lower parallel now. So you're looking at like 38, the 38 handle. Just below that, I have this slope confluence, 3780s, I want to say, Ted. But you know, a 618 of the rally is 3740. That's my line in the sand of where we'd start to get resumption and would threaten basically another run at the lows. So as it stands now, those are sort of targets on the downside. What would shift my focus to like, wow, we're in a way bigger reversal would be a break below 3740. I'm not expecting that at this point. Right now, I'm just looking for possible exhaustion into one of these levels. Does that make sense? Looking for a wave 2 rally before resumption. Right. Yeah. So if this is a 1, 2, 3, 4, 5, then yeah, you'd look for a larger recovery here. If this is wave 3, this could be 4 before the next 5. So this is why for me, guys, I love Elliott when it's plain and simple and right in front of you, right? When you can easily identify a 3-wave pattern or easily identify a 5-wave pattern, that information is important. But you don't want to spend too much time and put too much stress on sort of the wave count because you can get lost in the analysis here. So that's what I'd be thinking. But yeah, levels of interest to answer your question bluntly, Ted, 38.10 and basically this region here into 3770s first would be this slope. Both areas of interest of where you could see a near-term low. Anything sub 3740 would be resumption of the downtrend. Let's not forget where we're coming out of, guys. This is the simple yearly channel resistance. Nothing more, nothing less. Questions? So SPX first low, then up. So Jow, from where we are right now, again, I can't give you specific trade recommendations, nor should it be suggested as so. My humble opinion is, yeah, I'd be looking for a little bit of a deeper cut before resumption. Now, that doesn't mean we can't open up the week and push and test resistance first before we move lower. But the threat with the objective break of the monthly opening range lows is for a late month low in the SPX. And again, guys, objectivity, right? Staying sort of focused on what price is saying is the most important thing that we do here. That's our most important discipline. So if this is your monthly open, you set a monthly opening range low on the 7th, you try to break the monthly open and the monthly range highs, and failure, here's the break of the monthly opening range lows. We should be looking for a late December low. Now that doesn't drive with the Santa Claus rally, right? As everyone's starting to say. So if we do drive lower, that rally might end up sort of invalidating the opening range trade for the month. But that doesn't mean that the opening range trade doesn't have merit, right? You don't have to close at the lows, but you're looking for a late month low. It's the 19th, right? So if we get a low over the next couple of days, that might satisfy the opening range, and then you might get a larger recovery. But as we saw in retail sales on Friday, guys, we're not that strong. The consumer isn't necessarily on fire like it's been. So we'll see if Santa Claus comes in eventually or not this year. Nasdaq looks like this. I gave you guys an update on this one as well last week. Really compelling with the turn from yearly trend resistance. And I noted this with that reversal that we made. So as it stands on the weekly chart, Friday looked like it was really making that outside. It wasn't an outside weekly reversal per se, because I don't think we broke the highs, but failed at resistance, broke the lows. The risk was for move towards, 11,099, right? Basically 12 right here. Here's what it looks like. Let me show you the weekly first for the sake of consistency, right? Whoop. Focuses on what kind of reaction we get at that 12,000 region. Really, really important. The near-term charts for Nasdaq looks like this. Here's the daily. Oh, here's the daily. I showed you guys this last week, right? Two levels of which we were talking about possible resistance were the downslope, well, this convergence region right around 12,200, and then here, which you had the 200-day moving average. You got the 618 of the rally, or the drop rather, from the August highs. You can see that we didn't quite make it into the upper parallel of the uptrend, but we certainly tested yearly downtrend resistance, and that held. Big old reversal that day, right? So break below the median line. Here's the 25% parallel. That's where we closed on Friday. Here's the lower parallel, converges with the June low, and this year's low day close at 11,037. Okay, here's the low from June. Here's the low day close for the year. Converge on slope. Here's what the intraday chart looks like. So not only does all that stuff jive at 11,014, 11,020, all here, but guess what? A basic 618 of the rally is right here at 12. So any way you slice it, guys, this region between 12,000 and essentially 11,000, this 100 pip region, or this key zone right here is going to be what we're focused on as support on this drop right now. So looking for inflection there. If we get a close below it, likely to see an acceleration. But I'm looking for some sort of inflection into this zone. If you're holding shorts, a good area to start taking some off the table. If you're looking for new positioning, it's all about what kind of reaction we get into that drop. Okay. Jay, Mike, a quick question on gold. Sorry, did we break the monthly opening range high on the 13th of December? So we did, but that's called a failure of the opening range break, right? So when we look at the opening range, as I always tell you, it's the same as an inflection zone. If we're breaking the monthly opening range, I don't want to see a meander higher. It needs to be the break, acceleration. The fact that the close of the break of that session where we closed at the highs only closed pips above the monthly opening range, and then the following day we actually closed lower, that's a false break scenario. And in fact, if we break the opening range lows, it's what would be called an opening range reversal, where you try to break the opening range highs, fails. Once you break the opening range lows, that's when you actually get the resumptive move. So does that make sense, Jay, for gold as far as the opening range? I understand, thanks. Do you include the wicks for the range? No, Jay. For the opening range to have broken, we need a daily close above that range. And even then, nothing's guaranteed in trading, right? But the following day, the fact that the following day failed right at that parallel, let me move this, and then closed below the August highs again, for me, that was all I needed to be, okay, this is an opening range failure. Make sense, Jay? Very rarely do I use wicks. I use wicks for trend, but when you're trying to designate a break of reversal or a reversal on a trend line or a resistance or support, it needs to be the daily close. It says, okay, thanks. You're more than welcome. Good question. So that's NDX. Any questions on NDX? Here's, oops, that's the Dow. Here's NDX. Again, a little bit lower, looking for reaction to 11,000 for the next major move here. Last but not least, here's the Dow. Remember, the Dow is the only one that made a break of the yearly downtrend and even made a break of the August highs, but quick failure. Last week's range was massive. Last week's range almost covered the last 4 weeks price action. So the rally failed right at the February high week close, almost to the pip, guys. We had highlighted 34,738. The high was 34,712. Okay. So right now we're sitting at the 52-week moving average. We're sitting on a pivot zone for this basic slope, support, break, acceleration, breach, acceleration. That's where we're sitting. You need to close below 32,400 to get the resumption of the downtrend, in my humble opinion. Least conviction out of all the equity indices on this one, guys. And as we said last week, that non-confirmation high where Dow made a new high, but the Nasdaq did not, the S&P did not. Those can oftentimes be indicative, can be hallmarks, can be warning flags of opening of reversal trades. So keep that in mind. Dow on the near-term charts looks like this. Again, the breakout of that yearly downtrend, looking for support. Again, here's a 200-day moving average. Here's a basic 38.2. The rally, 32,400 is where we're looking for initial support on this pullback in the Dow. Any questions there? Okay, guys, I think I got most of your questions. Marcin, Euro, Aussie, there's only 2 I didn't get. So here's a quick look at what Euro, Aussie looks like. Let me see. So completely wrong, right? You had asked me to look at this. I think this was last week. And I was highlighting this possible pitchfork off the highs as we were failing at the low day close, the low, or the week monthly open and low close from January, right? Was a resistance zone that we were looking at. There's the breakout, super acceleration on Thursday. Friday pulled back a little bit. For this trade, we're gonna have to go to the weekly charts now. Let me see the Euro Aussie on the weekly. Oh, he says not me who asked last week. Okay, so this is something you're looking at fresh. So here's the weekly chart. If we take that last October high from 2020, last year's high, this year's high, you're at slope resistance right now. Two, three breakout. Yeah, this is a pivotal moment for Euro Aus. This is why I tend not to trade this pair. You can see, I mean, for range traders, this is your ideal, right? Where you sit in this range for quite some time. But here's the breakout, which would shift your focus higher on an opening range objective basis. But that yearly downslope has me troubled. You have this one off of just last year's high, and then on the weekly chart, you have that longer term one from 2020, right? So either way you slice it, I'd be neutral here. Marcin, if you put a pistol to my head, I would say the risk is for a pullback just off that trend resistance. But at the end of the day, the monthly opening range break suggests we should be looking for a late month high. So was that it on Friday? I'd be hard pressed. From here, I would say if we are heading lower, or if we are heading higher, any low or any pullback should hold 156 as support, 156.50. All right. The near term chart just doesn't have enough there for me to get super excited. Yeah, from here I expect to see some pullback, but not too much. You don't want to get too aggressive on this because it is a breakout of the monthly opening range. All the best, Mike. See you in the new year, says Generoso. Always a pleasure. Marcin, hope that helps. The other one you were looking at was Aussie Kiwi. I know I'm over on time here, but again, we got no time restrictions now. So let me just look at Aussie Kiwi for you because that was a pair that we used to be super interested in. So we're testing the 2019 lows as it stands right now. Here's the pitchfork I showed you guys. I think this was last month. Failure at the high, really strong support bounce off of the lower parallel. So at this point, yearly open resistance is something I'd be focused on. That's 106. 20, essentially 106.18. That's where we opened up the year objectively and the lows from March. So for me, a breakout of that zone would be the recovery play for Aussie Kiwi. The reason I haven't been too crazy about this is because I haven't really had a good stance on Kiwi. Since the start of the month, Kiwi's been holding resistance. It looked like we closed above it last week, but then we pulled back. So both Kiwi and Aussie are coming off recently. I think, you know, Kiwi might get a larger pullback. So I actually do like Aussie Kiwi, broadly speaking, higher. I just think at this point, you're at resistance, or rather you're at support. So I think you need to see a break above the yearly opening range highs, which would be at slope resistance, or the monthly opening range highs, excuse me, which would be at slope resistance. That would be sort of your breakout scenario play. So something like this. Just a quick on the fly analysis. I haven't been following this trade. Just on first glance, that's what I'd be looking at, Marcin. Hope that makes sense. RBA is on tap today. Might support a break. Yeah, so, oh, is the RBA on tap today? I didn't even get that. It's not on my calendar. It might be some commentary, but could be the catalyst. Sure, Marcin, to get the break. But you just rebounded off of long-term uptrend support. So that's what I'd be focused on. Oh, the meeting minutes. That's why it's not on my calendar. Yeah, I'm not sure you'll get too much gyration on that, Marcin, but might be, again, like I said, a catalyst event. For me, it's just all about last week's low. I mean, if we break below that, sayonara. All things held constant. I think you'd see a little bit of a rebound off that level. All right. Hope that offers some help. So guys, we'll wrap it up there. This is the last webinar of 2022. I want to thank you guys all for this year, for all your support over the last 13 years with Daily FX and moving on to better and bigger things. I want to thank you all for your participation. Best wishes for the new year, guys. Merry Christmas, Happy Hanukkah for whatever you're celebrating. Wish you guys the best. God bless for the holidays and have an awesome new year. I will see you guys on January 9th, excuse me, Monday, January 9th. We'll pick things back up. Stay light into the close of the year, guys. Like I always say, this is a time where retail will typically get chopped up, but there will be opportunities for sure heading into the close of the year. So stay nimble, maybe reduce position sizes, and really be a lot more meticulous with your entries. Really cherry pick those setups until we get through this holiday season. So best of luck. God bless. I'll see you guys next year. Have a happy, blessed holiday and new year, guys. Cheers.